on inflation, we do have a controversial call here. I think the prevailing wisdom is we have an inflation problem. This is not transitory. And I will say that the supply chain bottlenecks have lasted a lot longer than I would have expected. And the latest version of that is consumers running out and buying holiday gifts well before they normally would, because of supply chain issues that might prevent them from buying presents later. So we believe that the bigger risk here is deflation. I remember after 08-09, I was sure that the monetary easing would unleash, and fiscal policy easing would unleash inflationary forces. And I was wrong. Velocity, which I know you consider only a residual, but velocity went down. So the rate at which money turns over went down. People were scared. And we know from the 70s, it is when velocity picks up and when consumers and businesses try to get ahead of price increases and interest rate increases by buying now, that we see an inflation problem building and moving into wages as well. We are at a very important moment right now. Velocity is stabilized. It's ticked down in recent months. And I believe it will continue to tick down because what I just gave you was a deflation story, a secular deflation story, which, if we're right at how powerful this story is, will mean that velocity will continue to fall because prices are going to fall. And interest rates are falling. I think interest rates, you asked me the other day why I thought real yields were negative, 10-year yields negative. Do we really believe real GDP growth is going to be down negative for the next 10 years? I think there's a lot of mismeasurement right now taking place in the nominal GDP accounts. And if we're right, these statistics, having been born in the industrial age, do not account for the digital age. So that probably means that real GDP growth is higher and inflation lower. But it's very confusing. I will give you that because the markets are contradicting each other. Our focus is solely on disruptive innovation. We are not a generalist portfolio team. We are focused on the 5 platforms, innovation platforms, and 14 underlying technologies. But we're focused only on disruptive innovation. One thing I will say is, given the massive amount of innovation taking place right now, that is going to be highly disruptive, we do not believe that most asset allocators have enough allocated to innovation. And I think that the traditional benchmarks talk about risk because of these innovation platforms, DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technologies, because those are going to rip through the traditional world order and disturb it mightily, that those benchmarks are probably where we're seeing the bubble today. I know what I find so interesting about movements in the market today is the fear of interest rates and inflation picking up really started in February of this year as people were getting vaccinated. And the markets went after our strategy to express the risk and basically shorted our strategy. What I find so interesting about this is that the market's multiple, broad-based market, so S&P's multiple on next year's earnings is at 24 times. NASDAQ's is at 31 times. These are near record highs, except for the tech and telecom bubble. If inflation is really the risk out there, why isn't the entire market's multiple coming down? I remember when I started in the business, late 70s, early 80s, back then, I think by the end of the bear market in 1982, the market's multiple was down to 6. I just mentioned that we're up to 24 on that basis right now. Now, you're going after multiples in our space, and what has happened, the depreciation in our stocks from mid-February to today has not done anything to our forecast. We're now just getting our forecast. We're now just getting our companies and our stocks at lower prices. So in mid-February this year, as we did our 5-year forecast, and we assume massive multiple compression during the next 5 years to something like FANG multiples, EV to EBITDA in the 18 to 20 range. When we did that in February, at the peak of our strategy, the compound annual rate of return we expected from our portfolios was roughly 15%. Today, doing that analysis, some of our projections have increased. The compound annual rate of return we are expecting is close to 40%. So in February, we were expecting a doubling over 5 years. Today, we're expecting nearly a quintupling over 5 years. Well, first I should say we have started this ETF based on Paul Pagnotto's transparency metrics. Paul Pagnotta wrote a book called The Transparency Wave and reflected on what happened after 08-09 and what kind of stocks came out of that and have done very well. And it has been those stocks that, or those companies that are very transparent. So 08-09 had a big impact on him. He wrote a book about it. We've looked at the metrics. We are now certified as transparent ourselves. This index includes the 100 most transparent companies in the world. And it's an equal weighted index. Yes, what you see us doing, especially during periods where our style is out of favor, which is very unusual in a bull market, by the way, highly unusual, and we can get into that in a moment. But what we usually do is consolidate our holdings towards our highest conviction names. And a lot of commentators noted earlier in the year, during the February through May washout in the innovation space, that we sold our Chinese stocks. Now, in the flagship fund, we moved completely out because we are consolidating or concentrating our portfolio towards our highest conviction names. Now, that turned out to be a very good move. And we've seen that concentration work many times where we've lost some conviction. We still like a stock, would normally sell it, but we like these other stocks better. We have much more conviction in these other names. And those are the names in our top 10. So the Tesla, the Roku, Teladoc, Square, Shopify, and so forth. So that's when we make a lot of those moves. Of course, you saw us sell Zillow recently. It was a little bit of the same. Our style, it has been under pressure. Zillow does something most unexpected, changes the strategy that we thought they had been working towards for 10 years with Rich Barton, the founder of the company, coming back around to execute on this Zillow offers. And then they pulled out. They realized they didn't have the right DNA for it. And so we might have known that ourselves, I suppose, but it involved artificial intelligence. We thought Rich Barton was right there, was on top of it. So we did sell on fundamentals, that particular name. Well, I think they already have been. I think that's what started in February once vaccinations were hitting critical mass, or we could see they were going to hit critical mass, and we were going to get back to work. I think everyone was working very hard, but back into the physical world. And so this assumption that the Fed was going to tighten started to make its way into the market. I think that's one reason many of our stocks are down. Some of them are down 50 to 60%. And what we see happening today is the flip side of, well, it's a little bit like what happened during the coronavirus. As we entered it, there were algorithms out there, and this market is, I think, controlled by algorithms in the short term. And so what happened in the short term as we went into the coronavirus is algorithms picked up, seized on two variables. How much cash do companies have? And are they burning cash? Those two variables took some of our stocks down 50, 60, 70%. and those who took those stocks down, the algorithms, the momentum players, the obvious trade, those people were all wrong. Those stocks were some of the biggest rebounders because, especially in the genomic space, the genomic revolution helped us get to that vaccine and to those tests much faster than what would otherwise have been the case. Today, what do we have? We have algorithms focused only on the valuations of stocks today, maybe trailing 12 or maybe this year, very short term. So they are thinking, okay, high interest rates, kill those stocks. So we think it's already taken place. And by the way, and I think, Taylor, you mentioned this earlier, interest rates, after Chairman Powell said, maybe this is not transitory inflation, the bond market rallied. And so I think the bond market is saying that that point of view is incorrect.